Hi there and welcome to my video. It is called The Fed Makes Boom and Bust and What It Means for Gold. Since the middle of March 2022, the US Central Bank has hiked interest rates from 0 to between 0.75 and 1%, and it has indicated that it could hike rates up to 3% by the end of the year. That doesn't sound much, but the expectation that the Fed would end its extremely expansionary policy has already triggered something of a landslide on financial markets. Bond prices dropped, credit spreads widened, stock prices tumbled, prices for Bitcoin and other cryptos plummeted, and the prices of gold and silver also fell sharply. To better understand what rising interest rates are doing to the economy and financial markets, one must first understand what happens when the Fed cuts interest rates. The Fed injects additional credit and money into the system, and this artificially lowers market interest rates. People's consumption increases, savings decline, and firms launch new investment projects. The economy expands, a boom sets in. However, something goes wrong. The monetary stimulus allows the economy to live beyond its means. Eventually, the boom turns into bust. Why is that? After the increase in credit and money has made its way through the economy, raising goods prices, wages, and financial asset prices, moving scarce resources from less time-consuming production, that is, the consumer goods industry, to more time-consuming production, namely the capital goods industry, people realize that the boom was a one-off experience and return to their original consumption, savings, investment ratios. This makes interest rates rise, and people increase their savings at the expense of consumption, while firms realize that the profits of their new investments fall short of their expectations. They scale back investment and cut jobs. The boom turns into bust. By raising interest rates, the Fed essentially puts an end to the boom and soaring asset prices, which were caused by lowering interest rates in the first place. In a highly leveraged system, however, the economic and financial adjustment process caused by a bust can be particularly painful in terms of output and employment losses and a decline in asset prices. In fact, there's good reason to believe that the Fed could very well trigger a new financial and economic crisis by tightening its policy. Because the Fed does not know the correct interest rate. If it sets the interest rate too low, goods price inflation will continue or even worsen. If it sets interest rates too high, the economy tanks and financial markets collapse. The risk that something could go wrong is enormous, especially given record levels of global debt. It amounted to $301 trillion or 351% of global GDP at the end of 2021, according to the International Institute of Finance. The huge debt burden in the global financial system suggests that the room for interest rate hikes is relatively limited. It is not likely, from my point of view, that central banks are willing to cause a recession and high employment, a major stock market crash, a housing crisis, or a full-blown credit crunch to bring inflation down to around 2% in the near future, nor would the general public accept it. A likely scenario is that central banks will hike interest rates a bit more, but not to the point of crashing the system to lower inflation. This suggests that goods price inflation will remain elevated for longer, but may not spiral out of control. Real interest rates, that is, nominal interest rates net of inflation, will most likely remain in negative territory for years to come. In such an environment, stock prices can continue to trend higher after shedding their bubble element. What role do physical gold and silver play? As long as financial markets are reasonably confident that central banks can strike an acceptable balance between raising interest rates to curb inflation and preventing the financial and economic system from falling off the cliff, gold and silver prices may be prevented from rising sharply for now. As noted earlier, however, the risk that central banks will not succeed in their plans and cause a major crisis is real, and it is relatively high. And another major crisis could actually be deadly for the fiat money system. So there is a case for gold and silver. From my point of view, they are currently not expensive at all, especially when considering the prevailing financial and economic risk structure. With that in mind, holding gold and silver as part of one's liquid portfolio should ultimately prove risk mitigating and return enhancing for the long-term oriented investor. Thank you very much for your attention. If you enjoyed the video, please like, share, subscribe, and ring the bell.